Hi everyone, my name is John Kornacki and I'm the financial strategist here at the Federal Home Loan Bank of Boston. Thanks for joining us today for another edition of our case study series, this one titled Steep Yield Curve Strategies. I want to start off today by talking about what we're seeing and hearing from members as well as what's happening in the market. And I don't have to tell anyone that there's high levels of cash right now. You're seeing it from retail and business customers with the continued flood of deposits that have been coming onto balance sheets. And that's been a real challenge for members to deploy cash. And that goes into the next consideration. And one of the reasons why cash is not being deployed quickly is that loan production is spotty. Many of our members talk to us about certain products or loan segments that have picked up in production. But a lot of that growth is offset by the continued flow of paydowns from both scheduled and prepayment cash flows. So it's been very difficult to grow the loan book. And then the next consideration is, we've seen the yield curve steepen in recent months, and we're going to talk about this more in a few slides. But as we all know, this industry performs better with a steeper yield curve and a rising rate environment. And then lastly, what is your ALM position and how does that compare to last year? Are you making business decisions that align with what your balance sheet calls for? Or have you continued to follow strategies that have worked prior to the pandemic? And we'll talk about this and some of the things to think about. In terms of considerations, I want to start off today by talking about interest rate risk management. When we talk to our members, anecdotally, we hear about more and more members are asset sensitive compared to last year or previous years. And that's really no surprise. If you look at the asset side of the balance sheet, there's been an inflow of prepayments across the board, whether any loan product you've seen cash flows coming in as the rates have dropped. And especially when you look at longer duration assets like MBS or mortgages, the refinance activity has been robust. And that activity has largely stayed in cash. So the duration on the assets has dropped considerably for many of our members. And then on the liability side of the balance sheet, we've seen shifts in deposit trends. CD concentration has dropped with lower rates, and a lot of the deposit inflow has gone into non-maturity deposits. And when you model those cash flows, the non-maturity deposits are typically assumed to be longer duration, as many people will think that these are stickier and will be around for some time. So when you combine those trends, that leads to a more asset-sensitive balance sheet. And then if you look at the data from the OCC as shown here on this chart, we see that in fact most banks are asset sensitive. As you can see by looking at the x-axis, we're looking at different down rate and up rate environments and seeing what happens to earnings. So the y-axis is showing the impact to earnings. And as you can see, the median bank's earnings increase in a rising rate environment, which means they're more asset sensitive. And so what does this mean for members? It means that the risk for many of our members is that rates will remain flat or decrease over the next 12 months. And so the question to ask yourselves and discuss internally, what happens to your earnings in those rate environments and how does your balance sheet fare? And this is a very important topic, and we approach ALM from the position where we believe decisions should be made based on what your balance sheet calls for and not where you think rates will go, because frankly, no one is able to accurately predict future rates. Now let's take a look at the yield curve. As we know, last year was a very challenging year from really every angle. And when you look at the yield curve last year, it was historically flat. The spread between the 5-year and 3-month treasuries was 24 basis points. It was hard to justify extending duration with such a small spread between short-term and medium-term rates. The risk-reward profile was just not in your favor, and it was difficult to justify. So now if we fast forward to today, things have improved. Medium and long-term rates have risen quite a bit, where short-term rates have remained low. So you can see that the spread between the 5-year and 3-month treasuries is now 82 basis points. So with that, there are more attractive opportunities to extend out on the curve compared to last year. And as I mentioned in the last slide, This goes in combination with what your balance sheet calls for. So there may be more opportunities to take interest rate risk through funding short and lending or investing long in order to capture enhanced spreads. I want to dig a little deeper into the components of return and how today's environment compares to last year and prior years. Let's start off by talking about yield income. And for those of you who are not familiar, yield income is the income you receive from the coupon payments. And the example I'm showing here is the 5-year US Treasury, but over the next few slides, when I'm talking about these concepts, it translates to all assets, investments, and loans. So looking at the chart here, you see the historical yield income going back to 2016, and I've highlighted 2019 and 2020 averages. As shown by the light blue line, with the drop in loan and investment rates, yield income was challenging. Now, fast forward to today, you see, as shown by the 5-year US Treasury, we've bounced back up and are now comfortably above 2020 averages. Now, you may be saying to yourself, we're not even close to 2019 averages. It's still difficult to justify extending duration. And we're going to talk about this in the next slide. When you look at total return, yield income is just one component. We're now going to take a look at roll down. So what is roll down? It's essentially the benefit you receive as time passes and the asset moves closer to maturity. And we take the current curve and we roll down that asset. So as you can see from this chart, our roll down return is well above 2020 and 2019 averages. And that is due to the steepening of the yield curve, as we discussed earlier. So if you have a 5-year asset and assume no interest rate volatility, in 1 year, that asset, the yield income remains the same because we're talking about a fixed rate asset here, but you benefit because now you have a 4-year asset with the same coupon payment. So that roll down return is the benefit from going from a 5-year asset to a 4-year asset and looking at the current rate environment. When we combine yield income and roll down return, we can look at this from a total return perspective. And as I said before, this is not only for investments, but also for loans. But for the example I'm showing here, it's still a 5-year US Treasury. And you can look at how total return averaged 76 basis points last year compared to today at 184 basis points, which is just below our 2019 averages. In other words, pre-pandemic. And when you combine rising intermediate rates along with a steeper yield curve, this provides greater deployment opportunities for cash. As I mentioned in the last few slides, the analysis we've been discussing has assumed no interest rate volatility. So now we're going to take a look at some interest rate volatility and your ability to absorb that volatility. On the graph here, I'm showing an immediate rate shock and how much rate movement would be needed to equal your yield income. And that's currently at 17 basis points. And then the other shock I'm looking at is a 1-year forward rate shock and how much rates would need to move to equal a 0% total return. In both of these scenarios, you see that we're considerably better than last year. We see that last year we were looking at sub 10 basis points in cushion, where today we're hovering just around 20 basis points. And what this means is, now you have an increased ability to absorb rate shock compared to last year. And extending duration now looks much better than it did a year ago. And when we think back to the original considerations I pointed out, you can fill in gaps in your loan portfolio production, you can manage your interest rate risk, and deploy cash in a way that aligns with what your balance sheet is asking for. And then from an earnings perspective, most of our members are facing margin pressure. And with assets repricing, so this strategy can help mitigate some of that. And then lastly, it was difficult to justify extending duration last year, given the points we discussed earlier. But now you have an increased ability to absorb rate movements compared to last year. We're going to finish today's presentation discussing some of the ways that the FHL Bank Boston can help you fund assets on your balance sheet. And I'm going to say it again, we believe that you should make ALM decisions based on what your balance sheet calls for, and that goes for funding as well. So I'm going to go back to the considerations again, and the data from the OCC. We saw that the median bank is asset sensitive. So as you think about extending asset duration, can you take interest rate risk in this strategy? And the table here is looking at funding options with an example asset being a mortgage-backed security. At the FHL Bank Boston, we have a number of fixed and floating rate products along the curve, and I'm showing just a few here to give you some examples. The first option is a 1-month SOFR indexed advance with day one funding cost of 23 basis points. And if you're not familiar with this product, I encourage you to go to our advances page on our website or reach out to your relationship manager to learn more about this product. And then the other three options here are fixed rate advances up to 1 year. So depending on your funding needs and your ability to take interest rate risk, these options provide a way to fund longer term assets with short term funding. That concludes today's case study. I hope you found some value here. As always, thanks for listening in, and if you have any questions, you can reach out directly to me or your relationship manager. Thanks, everyone.